Hello friends, since the turn of the century, out of 21 Julys, the Nifty has favored bulls on 15 years and favored bears for 6 years. Will July 2022, the 22nd July since the turn of the century, favor bulls? In this video, we are going to tackle this very topic in this weekly market outlook. I'm Vijay Bhambwani. I've been trading these markets since 1986, and through my videos, I want to help my viewers and my online family to make higher trading profits, make more informed decisions using our in-house proprietary indicators you will not get across any media platform. That is our challenge. Let's dive right in. Last week in my video, I told you that the possibility of the market going up is a dead cat bounce rather than a complete trend reversal. The extent of the rise of the Nifty tells you that the bulls didn't really have that firepower to basically take the market up where it was needed to go to be able to rope in the people sitting on the fence. Now the market roundup window on your screen tells you that it was the Nifty that basically gained, whereas the Bank Nifty surrendered a little bit of position. The US dollar index, the Dixie, continued its rally. It crossed the 105 mark, the round number, which is basically negative for all emerging markets, including India, because we are import dependent and we have dollar denominated debt, and that pressurizes our economy. Crude oil continued to rise, which was another negative factor for the bulls, and basically we saw defensive buying coming in gold also, primarily because the import duty on gold was raised, which is why you're seeing a 2.66% gain. It's primarily the gain made on Friday after the duty hike announcement. Mercifully for us, natural gas prices are coming down, so households will have some relief hopefully at a later date. Now the USD INR has hit a lifetime high. This is a cause for concern. I'm going to come to this in a bit. 10-year benchmark bond yields eased, which is what cushioned the declines of the Nifty. I've been ahead of the market in telling you that you must watch the bond yields if you want to be a Bank Nifty trader or even a banking stocks trader. The NSE market capitalization gained 0.75%, which is a relief because we've seen some pretty sharp declines over the last couple of weeks in the month of June. The MWPL came down, which is routine on expiry, and it normally picks up till the third week of the fresh month. So nothing out of the ordinary there. The US markets continued to decline in spite of the gains that you saw on Friday, because net week on week, the headline indices have seen falls. The worrying part is that the S&P 500, which is a broader based index as compared to the Dow Jones Industrial Average, fell more than the Dow itself. The Nasdaq 100, which is again a little more broader based than the US Dow Jones Industrial Average, fell more than the Dow. So it's been a broad-based decline, and we are going to see in July what could be going forward, the reasons why the market might see a rally. Now for the US indices, I bring you the daily chart of the Dow Jones Industrial Average. This index has basically risen on 2 out of 5 trading sessions, and the death cross that I have talked to you about many weeks ago, where the 50-day moving average closes below the 200-day moving average and therefore creates downward pressure on the markets, remains in place. It's still not negated. So the rally in July, if any, is still a relief rally and not a trend reversal till at least one previous high, swing high on the Dow is not overcome sustainably. So it's early days yet. We are still below the moving averages. We are still below a swing high. And until that happens, we are in a relief rally at best. The Nasdaq 100 index, again, You can see that this witnessed a death cross far before the US Dow Industrial Average. This witnessed a death cross in the month of March itself. A lower tops, lower bottoms formation remains in place. Price is below its moving averages, which themselves are falling. So here again, you can hope for a relief rally at best. The S&P 500 Standards & Poor's 500 index has a similar death cross on its chart, and prices remain below the averages, which themselves are falling. So here you could basically look for a bounce, not a complete trend reversal in the coming week. Now let's go to the market-wide position limits. What I have been telling you is that this is a gauge of the two marshmallow traders. Now these are traders who roll over their positions to the next trading session. They have deeper pockets, they have higher conviction levels in their trades, and therefore their risk appetite is a barometer of how much the markets are going to bite the bait. Now what we are seeing is on Thursday, the market-wide position limits fell to 18.53 on the daily chart. While a decline is routine, but a falling below even the 19% mark is a cause for concern. Now, I've told you that in November we saw MWPL at 35%. We've never even crossed 30% as we'll see in the weekly chart that you're seeing on your screen. You can see that the MWPL, which is nothing but the positions taken by the investors as a component of the positions allowed to them by SEBI. So they are not even taking 29-30% of the positions allowed. And the MWPL has fallen to 19.75 on a Friday, which is at the extremely lower end of the 20-week range. That tells me that risk appetite is fairly curtailed. Now for the stock and index futures turnovers on a daily chart, this is a cumulative figure of 3 consecutive expiries. So this is July, August and September. What you are seeing is that the turnover fell on Friday, which is routine because in the build up to expiry, what happens is people square up their positions in June and roll them over to July. So the exchange records the turnover twice. Now, obviously on Friday, turnover falls because on Thursday you have, in the build up to Thursday, Tuesday, Wednesday, Thursday, 3 days, you'll see the turnover rise. But net, you are basically seeing that it's higher in the index futures. Now, here's the catch. Indices fluctuate anything between 1.25% to 1.75% on an intraday basis, whereas stocks can go up to 3.25% to 3.5% and 3.75% intraday volatility. So what I'm seeing is that risk appetite is shrinking. Traders are moving from stocks to indices, which by itself is a defensive thing to happen. Now, the same thing on the weekly chart with a 20-week look back bias. What I am seeing is that stock futures turnover has come down and index futures turnover has gone up. But both the turnovers are in the medium range, mid end of the 20-week range. It's not that the turnover has gone exceptionally high or trading interest from the one marshmallow traders who are basically day traders and don't roll over their positions is not really going to the moon. The Marshmallow Theory is covered in a separate video. The hyperlinks are in the description and in the pinned comment. It'll also appear as an end screen at the end of this video. Now let's see the Nifty and Bank Nifty prompt futures basis analysis. What is the basis? It's basically the premium or the discount prevalent on the index compared to the spot. It basically tells you the risk appetite or the premium that a trader is willing to pay to trade in a particular instrument. Now, the Bank Nifty saw a basis of almost 100 rupees. This is after a very, very long time. But do remember, at the beginning of a derivative cycle, just like you have options premium, which is at its highest and then it starts to decay as the month progresses, you are likely to see the basis at its highest at the beginning of the month, and it eases towards the end because you have 4 full weeks to trade around with, and therefore traders have higher risk appetite at the beginning of the month. But the Nifty basis is just about positive. Now this worries me. Why are traders not willing to pay a premium? Secondly, even if the Nifty is trading at a discount, which it has for almost all of last week, we are seeing two marshmallow traders who roll over their positions to the next trading sessions, are willing to sell even at a discount. Now that is worrying me. If I want a pullback rally in the month of July, I want the indices to be trading with a positive basis, not at a discount. Now the same thing on the weekly chart, you're seeing the Bank Nifty basis at its 5-week highs, whereas the Nifty 50 basis is sliding towards the lower end of the 20-week range. This is not exactly very good news, my friends. So we need to watch the basis very carefully. I update all these metrics on my social media account. Do take the effort to connect with me. My contact coordinates come at the fag end of this video, also in the description and pinned comments below this video. So I will help you update yourself with these metrics, with these studies every evening, and you can stay ahead of the crowds using this data. Now let's see the one marshmallow risk appetite by way of the advanced decline ratio. The number of shares rising versus the number of shares falling. What we are seeing is that the advanced decline ratio basically was above 1 for 3 trading sessions out of 5, and on Friday what you're seeing is the level being 1.11, which means for every 100 shares falling, there were 111 shares rising. It's just about favoring bulls. Now, this is the very first metric, the very first yardstick that will indicate that the markets are rising, the advanced decline ratio. It will show up on your trading terminal, it will show up on your mobile terminal app, it will show up on NSE's website. So keep your ears to the ground and monitor this metric every day in real time. Should the markets need to turn in the month of July, advanced decline ratio has to go higher. On the weekly chart, what we are seeing is that even though the advanced decline ratio has fallen on a week-on-week basis, it is not reaching the 0.20 to 0.45 levels that it stayed for many weeks in the last 20 weeks. It's still above 1. Like I said, this ratio needs to climb. Preferably, I would want the ratio to stay above 2 for a bull market to begin. Now, for the impetus chart, it's something that you've learned to rely on, to bank on, and to trust and trade upon. Last week, I told you that the impetus chart had fallen, and the possibility is the impetus would possibly stabilize and rise from here because it was oversold. Look at the way the impetus has risen, and now the indices have attempted to rise, but the impetus has remained flat. This is a very small, a very mild red flag for me. I would have wanted the impetus to rise along with the indexes rising, at least on the days when the indices logged positive gains. Now, this is something that I will be monitoring in real time, and I would suggest you keep your ears to the ground on this metric and keep a keen eye. The impetus chart on the weekly compression also tells you that impetus is at the lower end of the 20-week range. Now, this tells me that it's ripe to rise. Should it happen when the indices are rising, which is a probability in the month of July, because remember, out of 21 Julys, 15 have been bullish and 6 have been bearish. If at all it happens in the event of the indexes rising, if the impetus is also rising, it tells me that the bulls have the momentum behind them. the rally may have legs. Now, for the LWTD indicator, the lift, weight, thrust, drag, our latest in the exclusive array of indicators I've shared with you, behaved like a dream in all of last week. And it basically, as I've updated it on my social media accounts day after day, this told me that downsides would be muted. The bulls were resisting big ticket declines, and they were attempting to lift the markets higher whenever the indices were sliding. Now, this is a daily chart, so the outlook is valid only for Monday. What we have seen, in spite of the fact that the headline index, the Nifty spot, in percentage gain and loss is below the zero mark, the LWTD actually logged positive closing of 0.22, which means that on Monday, chances are declines will get bought into and the bulls may attempt to pull the headline index, the Nifty 50 particularly, upwards. Now the LWTD on the weekly time frame, and what you are seeing is after big moves, the Nifty percentage gain losses is a blue line and the LWTD is a red line. After big moves, lots of thrashing about, which is why volatility was its highest, the index seems to be settling down. The movements are getting smaller and the LWTD is appearing to stabilize at the level above zero. Should it stay above zero for entire 5-week duration in the coming week, I would say that the bulls are at least showing intent of being serious about pushing the markets higher. Don't forget, this is a metric that I update on my social media accounts every single day, so connect with me and update yourself on this metric. I now come to the footprint of the four type of participants in the market. What you are seeing is the daily chart of the FIIs. They've basically raised their stock long positions on a week-on-week basis and gone a net short on the indices, which tells me that they are basically taking a hedged exposure. I've now started showing you the positions even on a weekly compression so as to give you a longer term perspective. And what we are seeing is that the FII's index net long positions is at a 20-week high, whereas the index short exposure is also at 20-week highs. They've almost been never been this short in the indices. We now come to the DIIs who've basically reduced their short positions on individual stock futures and cut their index shorts as well. But they remain net short across the board. Why? Because they've been buying in the spot segment and they are hedging their delivery buys with shorts in the futures. Now take a look at the weekly chart with 20-week compression of the DIIs as well. What you are seeing is on a week-on-week basis, their short positions have come down and they're basically on the index at least never been this optimistic in 20 weeks. By way of optimism, cutting shorts is also optimism. Now, for the prop traders, these are brokers' own trades. They are second best to insiders because they know who's buying, who's selling, and how much. So they are the best source of information. What they have done is reduce their individual stock longs. While you can argue that this could also be because of expiry, and let's give them the benefit of doubt, it could also be expiry. So I would want to watch whether they are increasing their footprint in individual stock futures. As far as their index shorts are concerned, they are more or less the same. They've cut a few shorts, very mild amount of short covering in the index futures. And what we are seeing on the weekly chart what we are seeing is that these prop traders have basically reduced their stock futures to the median end of the 20-week range. If at all, July has to be a bullish month, we would want prop and retail guys to basically raise their exposure significantly. And the next in line is the retail daily chart. These guys have been doing most of the heavy lifting in the last 2 years, and therefore they are also holding the most amount of long positions. When they buy and they sell, they make a significant impact on prices by the humongous amount of holdings that they have. And what have they done? They've basically increased their index long positions marginally, but they continue to cut their stock longs week after week. And the weekly chart tells me that their index longs are almost at a 20-week high, but their individual stock longs are definitely at a 20-week low. They are not biting the bait. They are still not showing any signs of aggression. If at all the market has to go up, the prop and the retail have to raise their exposure, and it will show up in the advanced decline ratio from one Marshmallow traders and the MWPL from two Marshmallow traders. It's all very simple actually. You just need to observe, and the more observant you are, the better idea you'll have about the markets. Friends, the in-house studies done, I now come to the most critical aspect of the market. It's an area which I have been leading for many years now. I've been telling you that the bond market needs to be seen before you watch the equity market, because this is the source of all funds. And the outlook on the bond market definitely impacts the bank nifty and the banking stocks the most. So as a trader, you must watch this metric. Bond yields have eased, which means the bond prices have risen a bit. This gives a mark-to-market relief to banks who hold the highest number of bonds in the country. And now that the yields are basically coming off, it also leads you to start to believe in what I have been telling you on my social media account about laddering. I've been telling you to keep laddering your sovereign investments in a very disciplined SIP kind of a disciplined manner, so that you achieve the optimal return on investment on your money. So the RBI Retail Direct GSEC portal remains your best bet. You can buy and sell bonds from banks directly without commissions, without brokers or any intermediary. It's a beautiful avenue where the government of India is guaranteeing 100% of your capital as against 5 lakh rupees in a bank fixed deposit. Plus, you're getting 1.5 to 2% higher yields in spite of 100% guarantee. Keep laddering, guys. Enjoy this, enforce this discipline and enjoy higher returns. Now, will bond yields fall? In my humble opinion, I'm not expecting a decline below 7.2, if at all. But on the flip side, if it starts to go above 7.5, I would bet that the bank nifty will come under heat again. It'll start to experience pressure, it'll start to experience selling, and that is when you must be extremely cautious. So here again, watch the bond yields extremely carefully. It's available on almost all free charting trading platforms with the symbol of IN10. IN for India, 10 is for 10-year benchmark bond yield. Friends, the bond market done, I now come to the US dollar index, the Dixie, and this has a tremendous amount of bearing on the outlook on emerging markets, including India, because we are net importers and we have a lot of a debt in foreign exchange. So when the dollar becomes stronger, the landed price of our goods is rising, which results in imported inflation, and our debt of US dollar denominated overseas paper becomes a little more expensive to service and definitely to repay. On my Telegram channel on Friday, I gave you hyperlinks to an RBI report which said that approximately 50% of corporate India's debt in overseas dollar denominated currency is unhedged. What happens? That lends volatility to the rupee versus the Dixie, and I'm going to come to what it means for you. Coming back to the chart of the Dixie itself, you can see that this index has continued its upward march. It rose on 3 out of 5 trading sessions. The price is in a kissing distance of breaking out above the 105 double top area. Once it does that, it's trouble for emerging markets. The price remains above the 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. So the short-term outlook is also upwards for now. Switching now to the weekly chart, what we are seeing is a bullish engulfing pattern as the bullish candle is engulfing or overbearing the previous week's bearish candle. That tells you that the bulls are back. And the price is far above its 25-week exponential moving average, which is a proxy for 6-month-long holding on cost of a bull. So even the medium-term outlook remains positive for the US dollar index. If the US dollar index continues to rise, and believe me, if it goes above the 105, 106 levels, the challenge for the bulls increases. That is for certain. So keep a very keen ear to the ground, monitor this aspect and don't take it lightly. Don't let anybody convince you that bond yields and the US dollar index do not matter, and to trade equities, you only need to look at equities. I'm sorry, you need to take a 360-degree worldview of financial markets. You need to keep your boots on the ground but eyes in the sky and take a three-dimensional view of what's happening out there. Any and everything that impacts the price of any and everything that you buy and sell counts. All right. So last week, I advocated a range between 105.75 on the upside and 102.50 on the downside, which held perfectly well. In the coming week, I expect a range between 106.80 on the upside and 103.45 on the downside. Friends, the US dollar index done. I now come to the Bank Nifty, the second most traded derivative instrument on the NSE derivative segment. The index lost 0.26% in the spot on a week-on-week basis, but it logged gains on 3 out of 5 trading sessions, as you can see on the daily chart on your screen. Now, a couple of pointers to what's happening out there. The 8th March swing low at 32,155 is your pivot point. You need to watch this for signs of bulls being able to defend this in case the market declines. To note that the death cross, where the 50-day moving average is below its 200-day moving average, remains in place. It has not been negated. The price remains below its short-term moving average, which means that bulls continue to remain under pressure. And the gap which was left on the downside approximately a fortnight ago remains open. In spite of the fact that the market opened sharply on Monday and attempted to close the gap is not yet closed. So that's the first and foremost challenge for the bulls. In case July is likely to be a bullish month, at least this gap must be closed and the Bank Nifty must go above at least one previous swing high, which is close to the 36,000 levels, to be able to indicate that bulls are coming back. Taking the same chart on a weekly compression basis, what we are seeing is that there was a bearish candle. Naturally, week on week, it has lost approximately a quarter percentage point, and the price remains below its 25-week exponential moving average, which is a 6-month holding on cost, which means the medium-term outlook is marginally under pressure. But what is a little more worrying is that the average itself is pointing downwards. Number one, the price has to move above the average. Number two, the average itself must start to point upwards. What we are seeing is a lower tops formation building up, with support being constant at the 8th March low levels of 32,155, which is why the importance of 32,155 goes up in the coming few trading sessions. Do watch these levels very keenly, my friends. Now, in the week before last, this index was at number 5 on our in-house high volatility or statistical beta list, but it fell one notch to hit number 6, which is good. We don't want a heavy-weighted headline index like the Bank Nifty being too high on the volatility list, because it raises the challenge level or the difficulty level for a retail trader. Now, last week, I advocated a range between 35,300 on the upside and 31,950 on the downside, which held perfectly well. No credit to me. It's just that the market's intra-week range was smaller compared to what was expected on the basis of the week prior. So, a shorter compressed range automatically meant that these levels were respected. In the coming week, I expect a estimated range between 35,175 on the upside and 31,925 on the downside. Trade carefully, still continue to trade light, which is something that I have been warning you on my social media accounts. Friends, the Bank Nifty done. I now come to the Nifty 50, which is the most liquid derivative instrument out there, lowest impact cost and highest trader interest. It gained 0.34% last week, and it rose on 2 trading sessions out of 5. And those also happen to be the first 2 trading sessions of the week. The remaining 3 this index just happened to sink lower and lower. Now, the daily chart on your screen tells you that the death cross, which I have not indicated here, of course, the price is below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. So, the price where mark-to-market pressure is concerned remains on for the average bull. And the 8th March swing low, and remember on 8th March the Nifty and the Bank Nifty both made swing lows. 8th March swing low on the Nifty 50 was violated on the way down a fortnight ago. It was violated again on Friday, but mercifully the markets closed significantly higher. So watch the 15,671 levels odd, give or take a little bit for emotional turbulence. If the market, say for example, starts to trade sustainably below the 15,600 or 15,500 levels, the bulls are clearly on the ropes. The gap that I had plotted for you last week as well remains where it was. In spite of the fact that on Monday the markets attempted to go higher, at least in the Bank Nifty, the gap was attempted to be closed a little more seriously. In the case of the Nifty 50, the lower trend line of the gap was not even touched. And remember, the Nifty is a broader index as compared to the Bank Nifty. So broader markets are still not showing the gumption, the strength, the aggression, the confidence to close this gap. This is the first prerequisite I have for the market to rally in July. The gap will get closed at 16,173 levels. So this is what I want for the Nifty to do before I go out there and start buying again. Would I buy? Yes, I would buy provided my conditions are fulfilled. The first one being 16,175 being taken out forcefully. On the weekly chart, we are seeing a second consecutive green candle and the price remaining below its 25-week exponential moving average, which is a proxy for a 6-month holding on cost of an average bull. So this is the most serious correction that the Nifty has seen after the tremendous bull market that kicked off from April 2020 onwards. Now, the moving average itself is at 16,500 odd levels. So that is where one can expect the rally to go up to in July. If at all, the bulls find their feet, and July is a month that is likely to be kind and benevolent to the bulls. In the week before last, this index was at number 8 on our in-house statistical beta list. It fell 3 notches to number 11, which is, I repeat, a welcome sign, because a heavyweight index like this, being too volatile, raises the challenge level for an individual trader. Last week, I advocated a range between 16,350 on the upside and 15,050 on the downside, which held again. Here again, no credit to me. It was just that the intra-week range itself was narrow. Therefore, the markets respected the levels that I advocated. In the coming week, I expect a range between 16,375 on the upside and 15,125 on the downside. In the week ahead, or rather in the month ahead, what would I do in July if the market was to rise? Would I seek buy opportunities? Yes, I would, like I said, provided conditions are met. So the first and foremost being 16,173 being taken out. In that case, would I go out there and shut my eyes and throw a dart and pick anything that comes to my mind, come to my attention? No, definitely not. As a statistical systems trader, I would target where fear has led to the highest buildup of MWPL on individual stocks, and bears have become too complacent, too reckless, and become overconfident. So when the price is sliding and the MWPL histogram is rising, it tells me that shorts were built up aggressively. If at all the market is to boomerang and rise, it is these very stocks that will bounce viciously. Do remember that in a recent video which I made for you, talking about why bear market rallies are so vicious, this is precisely what I have said. In a bear market, the bull who is used to buying is as it is buying, and the bear is being compelled to square up his shorts. He's fearing that the market will go up and also turns into a buyer. So both parties are now trading in the same direction, which is up. The bull is buying long, the bear is cutting his shorts, but he's buying. So double pressure on the upside. So choose those counters, my friends, where aggressive shorts were built up and that aggressive short selling gets covered up in sheer naked panic, and you will make double quick profits in the month of July. Very simply, this is my trading strategy for the month of July. If at all I'm betting of even a minute pullback rally in the month of July, which I think is a fair probability, this is my game plan. Don't just buy any and everything, because we are still making lower tops and lower bottoms formation. Go with the highest statistical advantage and probability in your favor. I think if you stick to a very mathematical approach, there's very high probability of you making superlative trading profits in the month of July. And I wish you all the best. I want all my friends to be highly profitable in the month of July. So friends, the last chart that I have for you is the component of options turnover of the total derivative turnover on the NSE versus the futures turnover. What you can see is the light green line indicating the options turnovers is higher. So traders, not only is the MWPL falling, which is the risk appetite and the amount of limit that they are using as a total component of limit allowed by SEBI, it is falling. But out of that fall, they are taking a higher exposure and lower risk options because options are cheaper to buy. They are not buying too much of futures. This tells me that there is still caution in the markets. People are moving forward, but they are treading or they are walking very, very cautiously as if they are walking on thin ice. If at all the rally has to pick up momentum in the month of July, I want futures component as a turnover to rise sharper than the options turnover, which means risk appetite has gone higher and the bulls are biting the bait. They are digging their teeth into the market and taking bigger bites of the opportunities. Friends, all the in-house studies done, I now come to the most popular aspect of the market where I give you 5 stocks which have gained the highest amount of impetus over the previous day, where you take highest small exposure, and wait for large price moves to make your money. And 5 stocks that have lost the most amount of impetus, where you take big exposure and wait for small price moves. This strategy helps scalpers more than swing traders. Why the difference? Because different types of traders, different mindsets, different attitudes and approaches to the market. Therefore, I'm giving you tools for both. Remember, this list is valid only for Monday. And should you want to be updated Tuesday through Friday, connect with me on my Telegram channel. Request to be added to our WhatsApp broadcast list. And I will update you with this list every day. So here goes. For Monday, the highest gainers in impetus list was led by Abbott India at number 1, number 2 IEX, number 3 ITC, number 4 AU Bank, number 5 Dr. Lal PathLab. The impetus losers list is led by Vedanta, number 2 Power Grid, number 3 Tata Chemicals, number 4 Laurus Labs, and number 5 GSPL. Remember, this hierarchy changes day to day. Therefore, this list is valid only for Monday. Friends, I hope you enjoyed my video and I would love to hear any feedback that you have for me in the comment section. So go ahead, tell me what you think about my presentation and my work for you. Also, let me remind you to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And help me reach out to smart traders like yourselves by referring my video to your family and friends. Thank you for your patience, for watching my video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Connect with me on social media and stay ahead of the crowds. Bye-bye.